Hey, what's going on, everybody? It's Thursday, March 31st, end of the quarter. So we had some of this end of the quarter rebalancing action today. Portfolios selling stocks, buying bonds. If you were wondering what all that big selling was in the market, that's pretty much the reason behind it. You get this quarterly rotation, especially when you had the worst quarter in bonds, I don't know, ever or something like that. I think that's what they were saying. So rotation out of stocks and into bonds. That's how, a lot of portfolio managers, that's what they do. They'll buy the sector that was hit the hardest, and then they'll get out of the ones that did the best. And that's the thing. Like, I don't follow that. Like, I buy stocks based on valuation, and I tend to stick with that, and I use my macro analysis to give me the big picture. And if the big picture is positive, which it is now, then I use these market pullbacks to add to my position. So let's go over some stuff today. It was announced by Biden that he has a big plan to counter, Putin's energy hike. He's blaming it on Putin. And his plan was to release, I think it was 180 million barrels of oil from the SPR. Now you have to understand the details in this plan. First of all, just on face value, you got to understand that whatever is released will almost certainly get exported. I mean, we are now, the United States now, as I've been telling you, is a net exporter. So even now, with the production that we have and with the tight inventory situation that we have, we are a net exporter of crude and petroleum products. So the addition that comes from the SPR, I mean, most of that, if not all, that's going to be exported. So we're going to draw down the SPR, but there's a catch in that drawdown, and I'm going to explain it in a second. We'll draw down the SPR and we'll export it out, and so the foreigners will have the benefit of that oil, basically. That's what it comes down to. But the catch in this is the administration also said that they're going to replace the oil from the SPR by buying oil as long as the oil price is not above $100. So you understand? So as long as it's above $100, they're going to sell, a million barrels a week for however long it takes to fulfill their quota of taking out that SPR and putting it into the market. But it's basically the fact that they're going to be rebuying again as long as oil is not above $100. That's basically like having a $100 put on oil. So once the oil price dips below 100, the government's going to be in there buying again, and that's going to be a supportive factor. So it doesn't seem to me like that alone is going to be enough to suppress the oil rise. But I will say this, and I think I pointed it out yesterday in my video. We have seen in the last 3 weeks some reduction in gasoline demand. Okay, I spoke about that yesterday. There was also a pretty significant decline in distillate demand. Jet fuel demand was down. Refiner inputs, which is crude demand by refiners that they put into their refineries, that was up, and it's at a fairly high level, not a historically high level, but it's at a recent high. But if product demand comes down, if product inventories start building up again, you'll see that crude demand on the part of refiners here, that's going to go down too. So I'm more focused right now on the demand situation. I think that's the key thing right here. It's not plummeting, but it does look like it's slacking off, and that could be an element of weakness for the market, at least in the near term. And actually, I don't know if I said this in a video, but I did send it out to my subscribers several days ago that I thought oil was probably a short when it was trading up around 107 a barrel. Tomorrow we'll get to see the positions in the futures markets that are being held by producers. I've been mentioning now it's been something like, I don't know, 13, 14, 15 weeks that they've been net long futures. But last week we did see them as net sellers, even though they're still long, but that reduced their long position. But they were a net seller when the market ran up last week. So we'll take a look at that again tomorrow and see what their positions are. Yesterday I talked about, I was a little bit concerned about the fiscal. I have to make an announcement that I screwed up a little bit on my database. I for some reason, plugged in some wrong data. And actually, we are now at, I said we were at 550 billion for the month of March yesterday, but that was because I somehow screwed up the data. I went back and I checked that today because when I put the new figures in for today, it didn't make any sense. And then I saw I made a mistake in my data entry yesterday, and we're actually now at about 611 billion for March. That's really good. We still have one more statement day left in March. So we're going to be up around, probably up around 630, 640 billion. That is a strong month. That is a strong month. Oh, I'm sorry. Did I say 610? It was actually, we're at 622 billion. So we're going to be up around 640 billion. And that was, that's right in line with what I was saying. I said we're going to have like a 650 billion month, and that's exactly where March is coming in. From what I'm hearing, there's also still problems at the IRS with getting out refunds, and so we could have still a pretty decent refund month in April. So that will help because usually, like I said, February and March, those are the two biggest fiscal months, and then it starts to trail off. But we could get another decent month in April if we have, these IRS refunds that still have to go out that haven't been processed yet because of backlogs at the IRS. But April is a tax month, which means April 15th, we got to pay our taxes. And that's why a lot you hear this old saying, sell in May and go away, because you got that drain, you got that tax drain in mid-April, and that just, sucks that income, sucks those savings out of the economy, and it takes several months. It takes usually till back in the summertime when we start, then the government, what happens, the government just spends that right back out again, all right? It gets sucked away, but, that goes into the Treasury general account, and that, just gets recycled right back out there in more spending, and we get that. What they usually expect is that summer rally. I think fiscal's going to stay okay. I think we're still going to be up around the 600 billion level. Yesterday I talked about how we're living in this real-time laboratory of, what we're hearing in terms of expectations with respect to Fed rate hikes and quantitative tightening. I'm going to talk about that in a second, and I have been speaking about that in prior videos. But my contention is, and what I've been telling you guys, is that this, kind of embedded fear over monetary policy is just wrong, and it's going to play out. We're going to see the evidence of how it is wrong further on down in the year, when you're not going to have the extreme, bearish reaction that everybody is talking about. I mean, still here, I see comments all over the place about how this is a rally in the bear market and yada, yada, yada. There's no discussion of the fiscal. There's no mention of the fiscal. There's no mention of the bank credit expansion. Let me talk a little bit about this quantitative tightening, and it's something that I have been explaining to you guys. Like, first of all, there's no such thing as quantitative easing and tightening. They're neither an easing nor is it a tightening. Like I said yesterday, these operations merely are just a recomposition of dollar assets in the economy. Either you're going to have more reserves and less securities, or more securities and less reserves. Treasury securities are dollars, like I said yesterday, with a term and a coupon. They're just another form of dollars. So you're just getting a recomposition of the dollar assets in the economy. Quantitative tightening, I think I went through this yesterday, and I saw one guy, and I think he's on CNBC a lot. If that means anything, I don't know. I did television for a long time, and I sat on panels with idiots, basically, to the point where I had to get out of there because it was driving me crazy. But he said, well, quantitative tightening is going to be really negative for stocks. But why? Why? All you're doing now in quantitative tightening, he said if the Fed reduces its balance sheet, it's going to be very negative for stocks. Why? The only thing to be concerned about, or to be cognizant of, is if the balance sheet reduction results in a reduction in reserve assets in the banking system, so what? I mean, all you're doing is replacing reserve assets. You're removing reserve assets, which allows the banks to hold other assets like treasury securities and loans. Why is that bearish? If the banks are going to be buying more treasury securities and making more loans, that's not bearish. I mean, this is why I'm saying, like, these beliefs are ingrained in people's heads because they've been, they've heard it so many times and they believe it to be true, but they don't even take time to try to understand the reality of what's going on, to try to understand, the mechanics of it, the actual, what is actually happening. What is actually happening in is quantitative tightening. And again, tightening is a completely erroneous term. I mean, it's not a tightening whatsoever. It may not even be, an easing. It's neither of the two. All it is you're taking reserves away, and that clears room, that makes room on the bank balance sheets to add other types of assets. And those assets are typically going to be treasury securities, or MBS, and loans. So I don't see that as a negative thing. I mean, you want to have loans. Like I said yesterday, if we're in a situation where fiscal is moderating a little bit from levels we saw last year, if you're in that kind of a situation, then it's good to have an expansion in bank credit. All right. Now, I understand that can't keep going on forever because there's limits to that. There's limits to how much credit banks can provide depending on their capital. There's also limits to how much credit borrowers can take on depending on their borrowing ability. That's their income and how much debt they have, et cetera, and the cost of servicing that credit, which the Fed's going to be pushing up interest rates. But it's not a bad thing to take away, reserve assets and allow the banks to have other assets. And if the banks are buying treasuries, then we could see some relief in bond yields. So, I mean, when I hear stuff like that, I mean, actually, like I said yesterday, I get a kick out of hearing stuff like that because it shows me, and this particular guy I'm alluding to, like, he's considered like a real guru in the markets and a stock picker and this and that, but it just doesn't make any sense. I mean, you're spewing out things that are on a kind of a rote basis, just something he heard without trying to understand. I'm sure the guy has the mental capacity to understand, but you have a lot of this. This is typical of what goes on. People just repeat stuff because they heard it, and then they assume it has to be correct because everybody says the same thing, but it's not correct. All right? So don't worry, everybody. Things are okay. We're going to be good. Check out the guns. We're going to be good. I'll let you know if things change, but right now I don't see any big change on the horizon, so enjoy it. Today was a rotation day. Nothing to be upset about. Tomorrow, we'll see what happens with that ruble situation and Russian gas flows to Europe and to Germany. Putin says he was going to shut it off. We'll see what happens. Talk to you tomorrow. Bye.